There's one asset every market trusts. Banks post it for loans. Governments hoard it for reserves. Traders use it as margin. And foreign nations use it to store the past and finance the future. U.S. Treasuries aren't just government bonds, they are the foundation of the global financial system. But what happens when even that foundation cracks? Follow the threads, from debt ceilings to downgrades, and ask what it means when the safest asset on earth flinches.
The bedrock of the entire global financial system. Not just banks or, stock markets, but the fundamental thing that central banks hold, that loans are backed by, that underpins trillions in trade. What happens if that starts to crumble?
Well, for decades, that bedrock has been the debt of the United States, specifically U.S. Treasury securities. They've been seen as like the safest asset on the planet, the trusted anchor holding together central banks, major financial institutions, and, well, the vast plumbing of international trade.
But what if that anchor suddenly became radioactive? What if the unthinkable, a U.S. default, became, a real possibility? And maybe not even because the U.S. economy collapsed, but because of political disagreements right here in Washington.
We'll explore how the intricate web of global finance means a U.S. default wouldn't just be an American problem, but could potentially trigger a worldwide catastrophe.
Okay, so to do that, we'll first need to understand how U.S. debt became so deeply threaded through the world economy. Sort of trace its path from, say, post-war agreements right up to the mechanics of today's financial markets.
Then we'll confront the unique risk of a U.S. technical default, the kind driven specifically by domestic politics, and explore the immediate chaos it could unleash on markets and, frankly, beyond.
And finally, we'll look back. Look back at major sovereign defaults throughout history, learn from the experiences of countries like Argentina and Greece, and maybe crises in Asia and Russia, to see what lessons we can draw, understand the limits of containing such events, and really underscore just how different and potentially devastating a U.S. event could be.
Yeah, and this isn't just an abstract conversation about finance, right? It's about what happens when the safest store of value suddenly carries risk, when the collateral underpinning trillions, literally trillions, in global transactions just vanishes, and when the very language of international trade becomes, well, uncertain.
So it's about peeling back the layers to understand the hidden vulnerabilities within the system that governs global prosperity.
How did U.S. Treasury securities end up being described as this kind of universal glue in the global financial system? The backbone of the global financial architecture, as some sources put it. That's pretty fundamental.
It is. It's a status they really earned over decades, becoming a fundamental thread woven into the fabric of global financial markets. They serve several key roles, sort of all at the same time.
Which are?
Well, first, they are the primary reserve asset for central banks worldwide. You can think of them as the world's emergency savings account, basically. They also serve as benchmark collateral for an enormous volume of transactions. And they act as the underlying foundation for international trade settlements, all tied into the U.S. dollar system.
Okay, that sounds less like an accident and more like an engineered evolution. Where did that start? You can really trace it back to the aftermath of World War II, specifically the 1944 Bretton Woods Agreement. This pact established the U.S. dollar as the absolute linchpin of the international monetary system at the time. The dollar was pegged to gold at a fixed rate,
Right.
and every other participating currency then pegged itself to the dollar.
So if your currency was pegged to the dollar and the dollar is pegged to gold, well, you essentially needed dollars to manage your own currency's stability and convertibility.
This arrangement inherently made the U.S. dollar, and by extension U.S. government bonds, the world's primary reserve currency. Central banks worldwide began accumulating dollars specifically to stabilize their own currencies against that dollar peg. Global confidence was incredibly high then, mainly because of the U.S. economy's dominance and the promise you could convert those dollars into gold. So dollars and U.S. treasuries quickly became the main reserve assets countries held, not just to back their monetary systems, but also for intervening in foreign exchange markets when needed.
But Bretton Woods broke down, didn't it? In 1971, when the U.S. ended gold convertibility, did the dollar's reserve role disappear then?
Remarkably, no. Even with major currencies moving to a floating exchange rate system, the dollar's reserve role remained firmly intact. Despite, many predictions of the dollar's decline in the decades that followed, it never really fell below about 50% of global reserves in the modern era. Still dominant.
What was the key reason it persisted after the gold link was cut? Seems counterintuitive.
Well, a major factor was the emergence of the petrodollar system in the 1970s. Global oil trade, which is just massive, shifted pretty much entirely into dollar invoicing. This meant that major oil exporters, particularly Saudi Arabia and OPEC members, were suddenly earning vast amounts of dollars.
And they had to do something with all those dollars, I imagine.
Precisely. They recycled those vast dollar earnings back into U.S. assets. One notable example is a 1974 agreement between the U.S. and Saudi Arabia where the Saudis agreed to invest their oil revenues in U.S. Treasuries.
Ah, okay. So, right as one source of demand linked to gold ended, this huge new source of international demand for treasuries emerged from oil sales.
Exactly right. This ensured a steady international demand. And by anchoring oil and commodity trade in dollars, the petrodollar system really entrenched the dollar as the indispensable currency of international trade and finance. This, in turn, meant central banks had to hold dollar reserves for their energy imports and other trade needs. And treasuries were just the natural place to park those dollars because they earned interest and were highly liquid. Very convenient.
That explains how it stuck around. Has anything else challenged it more recently? I mean, the euro, for example.
Well, through the 80s and 90s, the dollar retained its dominance pretty easily. Japan's yen peaked around 9% of global reserves for a time, but that faded. The creation of the euro definitely offered another alternative, and today the euro accounts for a significant portion, maybe roughly 1/5 to 1/4 of global reserves.
But the dollar is still way ahead.
The dollar has persisted at roughly 60% of global foreign exchange reserves through the 2000s and 2010s. And in absolute terms, foreign central banks and private investors collectively hold trillions. As of early 2025, overseas investors held about $8.8 trillion in U.S. treasuries.
$8.8 trillion. That's just a staggering amount of the world's savings parked in U.S. government debt.
It really is. And the enduring appeal of U.S. debt basically boils down to three things: unmatched safety, liquidity, and stability. Central banks want to hold reserves in a currency with large open financial markets so they can access funds quickly, especially, in a crisis. The U.S. Treasury market is, by far, the world's deepest and most liquid government bond market. It perfectly fits that need.
So it's that combination. Incredibly safe and incredibly easy to buy or sell large amounts quickly.
Yes. When central banks hold dollar reserves, they overwhelmingly hold them in U.S. Treasuries. They trust that they can sell or pledge these bonds quickly at a predictable value, even when things are turbulent globally. They are seen as the quintessential safe asset for reserves.
And no other country's bonds really match that combination at this scale.
Not at this scale and with this level of market depth, no. And this status wasn't just granted, it was cemented by positive feedback loops. Because so many institutions and countries use the dollar and treasuries, their liquidity and confidence remain high. And because they are so liquid and trusted, even more institutions choose to use them. It's a self-reinforcing cycle. U.S. Treasury securities truly form the anchor of central bank portfolios worldwide and are a cornerstone of global monetary stability.
And this gives the U.S. what's been called the exorbitant privilege. Can you explain that?
Correct. Because global central banks and investors are so eager to hold U.S. debt, the U.S. government can borrow at lower interest rates than it otherwise could. Treasuries provide overseas holders with that valuable service of safety and liquidity, so they accept lower yields on U.S. debt. It's a trade-off. This allows the U.S. to finance its deficits more cheaply and even run persistent trade deficits because foreigners are willing to continuously accumulate its debt as a store of value.
That's quite the arrangement. They buy our exports, earn dollars, and then lend those dollars back to us cheaper than we could borrow from ourselves. Essentially financing our ability to keep buying their stuff. Oh, it sounds almost too good to be true.
It is a unique position, and the pervasive use of treasuries extends beyond central bank reserves into private banking and trade networks, creating even more layers of interconnectedness.
Okay, let's pause for a sec. So far, we've seen U.S. Treasuries become the global standard. From being the key reserve asset under Bretton Woods, solidified by the petrodollar system, they serve as the reserves for central banks and the foundation of global stability. Beyond reserves, what about treasuries being used as collateral? That sounds like it gets into the actual, the plumbing of the financial system.
It does. Another key link in this global chain is the use of U.S. treasuries as collateral within the international banking system's infrastructure. Banks, dealers, hedge funds, other institutions worldwide rely heavily on treasuries to secure their short-term funding and trading activities. This happens in two major areas: the repo market and derivatives markets.
The repo market sale and repurchase agreements. That's where banks essentially make overnight loans using securities as backing.
That's a good way to think of it. Repos are short-term loans, often just overnight, where one party sells securities with a promise to buy them back later at a slightly higher price. They're a fundamental tool for banks and investors to manage their daily cash needs and financing. And U.S. Treasuries serve as the principal collateral in repo transactions worldwide.
Principal collateral, how much of it? Like what percentage?
In the U.S. repo market itself, Treasury securities make up roughly two-thirds of all collateral posted. That's huge. In Europe, where they tend to use domestic government bonds, it's over 90% of repo collateral. But two-thirds in the giant U.S. repo market alone is a massive number.
Why treasuries specifically for this? What makes them so suitable?
Well, lenders in a repo need assurance that if the borrower defaults, they can sell the collateral quickly and without significant loss.
High-quality sovereign bonds like treasuries fit this perfectly because their credit risk is considered basically zero, and their market value is reliably transparent and stable even when markets are stressed.
So banks use treasuries to get cash cheaper and easier than, say, unsecured loans. If a bank needs dollars quickly, it can pledge its U.S. Treasury holdings in the repo market. Because the loan is backed by top-tier collateral, the interest rate is very low. And this isn't just happening in New York. It operates through global financial hubs like London and Singapore. An international bank can use universally accepted U.S. Treasuries to obtain dollars in the repo market, helping fund their balance sheet or client trades. So in this way, U.S. Treasuries grease the wheels of global interbank lending, acting as a universally trusted IOU that can be exchanged for cash almost on demand. As one source put it, confidence in U.S. government bonds is critical to the stability of the global financial system.
Okay, so repos are one piece. What about derivatives?
Yeah.
Things like futures, swaps, all that complex stuff.
Treasuries are also prevalent there as collateral for margin requirements. When institutions trade these complex instruments in major financial centers, they have to post margin, initial, and variation margin to cover potential losses. Clearinghouses and other counterparties demand this margin in cash or very safe securities. And Treasury bonds are commonly accepted due to their high credit quality. A trader can often use T-bills or bonds instead of actual cash for margin, maybe with a small reduction in value, a haircut, because they are considered nearly as good as cash.
So treasuries really do sit at the core of global collateral chains, and it sounds like they're everywhere.
They really do. They secure repo loans that fund trading positions, and they backstop trillions in derivatives exposure. This is where the idea of treasuries as the global safe asset really underpins market confidence. In stress times, access to treasuries can be the difference between meeting margin calls and being forced into, well, fire sales of assets at a loss.
And U.S. monetary policy affects this too, like the Fed's actions.
Yes, definitely. Because the Fed's actions and treasury issuance influence the supply and demand for treasuries. When the Fed adjusts rates or buys or sells bonds, QE or QT, it alters the availability and price of treasuries, and that impacts repo rates and lending conditions globally. We saw this during the dash for cash in 2008 and again in 2020.
Right, that March 2020 panic where even the treasury market itself seemed to struggle. That was scary.
Precisely. During crises, demand for treasuries as secure collateral just surges. But in March 2020, the pandemic triggered such a massive dash for dollars and collateral that even the U.S. Treasury market briefly seized up. It became hard to find buyers even for treasuries for a bit.
That sounds terrifying, frankly. The market that's supposed to be the most liquid freezing up.
It really was a moment of concern. This rare illiquidity in the treasury market caused serious concern about the functioning of the repo market. It prompted extraordinary interventions by the Fed just to restore order. These episodes really underscored that the smooth functioning of the treasury market is essential to global financial stability because so many other transactions rely on treasuries as the baseline asset.
So U.S. treasuries are the collateral anchoring the world's financial system, but it all depends on trust that the U.S. government will pay its debts without question on time.
It's a system built entirely on that fundamental assumption of unimpeachable creditworthiness.
Okay, quick recap again. We've now seen how U.S. treasuries function as collateral in global banking and derivatives, essentially greasing the wheels of trillions in financial transactions, all relying on the fundamental trust in U.S. government debt. Beyond banks and central banks, how does U.S. debt facilitate international trade and payments? How does it connect there?
It's deeply integrated there too. The US dollar is the dominant currency for, well, almost everything in global trade. Invoicing, cross-border payments, financial messaging, and US treasuries are just deeply entwined in this. Countries trade in dollars, they settle obligations via the dollar-based banking network, and then often park their trade surpluses right back into US debt. It creates this continuous loop tying global commerce directly to treasuries.
Most world commerce happens in dollars, right? Even if the U.S. isn't involved in the trade.
Yes. Roughly 80% of global trade finance, like letters of credit, is denominated in US dollars as of 2024.
So even if Brazil buys machinery from Japan, they're likely dealing in dollars, not reais or yen.
And key commodities like oil are almost universally priced in dollars due to that petrodollar convention we mentioned. This means importers worldwide have to obtain USD. Even if neither the buyer nor the seller is American, the dollar serves as that essential vehicular currency, kind of like how English serves as a common language in international business.
The SWIFT network is another good illustration of dollar dominance, isn't it? The messaging system.
It is. SWIFT is the messaging system banks use for cross-border payments, and nearly half of all global payment messages involve the US dollar. In August 2024, it was specifically 49.1% in USD, compared to just 21.6% for the euro, the next largest.
Wow. Nearly half of all cross-border payment messages. That's dominance.
And if you exclude payments within the Eurozone itself, just looking at truly international payments, the dollar share rises to an astonishing 60%. It's the de facto medium for most cross-border transactions. The network is so entrenched that no other currency comes close. This prominence means banks worldwide have to maintain dollar reserves and liquidity, often in the form of treasuries, just to service their clients' trade needs.
Okay, so countries earn dollars from trade. Where do those dollars typically go? Back into the U.S. system.
That's where treasuries come back in. When countries have trade surpluses and earn excess dollars, they often invest those funds in U.S. assets. And treasuries are the primary destination because of their perceived safety and lack of inflation or default risk.
So countries that export a lot to the U.S., like China or Japan, end up financing our trade deficits by buying our debt.
In a way, yes, it's a feedback loop. Nations with chronic trade surpluses against the U.S., China, Japan oil producers accumulate vast dollar reserves, which they then plow back into buying U.S. Treasury bonds. As of early 2025, the two largest foreign holders of treasuries were Japan, holding about $1.12 trillion, and China, holding around $0.78 trillion. Huge sums.
That's the vendor financing loop people talk about. The U.S. runs trade deficits, and those dollars sent abroad are recycled back into treasuries, financing the deficit.
The trade settlement system directly feeds demand for treasuries. Growing global trade, mostly dollar-based, leads to growing global holdings of treasuries. International banks use their treasury holdings to manage dollar liquidity and settle those large international payments. Like a South Korean bank needing dollars for a client might use U.S. bonds as collateral to get them in the interbank market. Even the U.S. Federal Reserve, in crises, has provided dollar liquidity to foreign central banks through swap lines, sometimes accepting treasuries as part of the exchange. This highlights that treasuries are effectively treated as good as cash in global dollar operations, reinforcing the dollar's role as the trade settlement currency.
But what about sanctions? Doesn't the U.S. using the dollar system for sanctions push countries to find alternatives? We hear about that.
It's a consequence, certainly. Sanctioning countries out of the dollar system makes it much harder for them to engage in normal trade, which ironically underscores how entrenched the dollar network is. This has prompted discussions of alternatives, like proposals within the BRICS bloc to settle trade in local currencies.
But that faces an uphill battle. It's hard to replace something so established.
A very steep one. The existing dollar system has overwhelming network advantages, basically. It works because everyone uses it. Until there's a comparable depth of market and trust in another currency's debt, which would require decades of policy and openness, U.S. treasuries and the dollar will likely continue to be the safe nexus for international trade settlement.
Okay, another quick pause. The U.S. dollar and treasuries are deeply entwined with international trade and payments. The dollar is dominant for invoicing and payments, and surplus dollars earned globally often get recycled back into U.S. debt, creating a powerful, self-reinforcing system. It sounds like these network effects you mentioned are really entrenching this system, making it hard to change.
The global role of treasuries wasn't accidental. It's reinforced by powerful network effects and feedback loops. These dynamics operate in both the official sector, central banks and governments, and the private sector banks and investors, creating a self-reinforcing cycle. The more the dollar treasury ecosystem is used, the stronger and more entrenched it becomes. It feeds on itself.
It's that everyone else is doing it, so I should too. Dynamic, right? Safety in numbers.
Yes, it's a positive feedback loop. Central banks hold dollars in treasuries, partly knowing they'll be accepted by others for payment or intervention. It's a form of mutual confidence. Private banks and corporations use dollars and invest in treasuries because they are the standard, the incumbent unit of account everyone recognizes. This creates significant inertia. As one expert, Carla Norloff, puts it, this positive feedback and network effects discourage collective action against the status quo. No single country or bank wants to be the first to abandon treasuries. It's too risky individually. This leads to path dependence. The more the system has been used historically, the more useful and entrenched it becomes today.
And the sheer liquidity of the U.S. Treasury market itself is a network effect. The fact that it's so easy to trade.
It is. It's the largest, most liquid government bond market in the world, making it easy to buy or sell large quantities quickly without moving the price too much. This high liquidity attracts more participants, which further increases liquidity in a virtuous circle. It's very hard for competing assets to break in because they lack that existing user base and market size. Also, because treasuries are so widely held, countries have a vested interest in the stability of the dollar system. Large holders like Japan and China have a lot to lose if they try to undermine the market by selling aggressively. This tends to deter destabilizing actions.
Even if it sometimes leads to diplomatic tensions because they're holding so much U.S. debt, kind of like financial hostages.
Yes, their holdings can feel like a form of leverage, but also make them hostages to the value of those holdings. It cuts both ways. And macroeconomically, foreign investors buying U.S. debt allows the U.S. to run persistent current account deficits without a currency crisis. Dollars sent abroad for imports are recycled back into treasuries, financing the U.S. deficit and keeping U.S. interest rates lower than they might otherwise be. This allows the U.S. to continue acting as a consumer of last resort for global exports. Some economists call this the balance of financial terror, or maybe a more symbiotic relationship. Surplus countries need the U.S. market and a safe place for savings, treasuries, while the U.S. needs foreign capital to finance its spending.
So the system is incredibly entrenched. Deep roots.
It is. It's often called the post-1945 dollar order. It's not officially mandated. It earned the status through economic size in these network dynamics. The IMF acknowledges the dollar's primacy has been remarkably durable. The cost to displace it would be enormous. Many developing countries have dollar-denominated liabilities, so they hold treasuries as a hedge and to meet those obligations if their own currency falters. It really does sound like a collective action problem where everyone's rational individual decisions lock the system in globally. Very hard to change course.
But this tightly woven fabric isn't without risks. It sounds strong, but maybe brittle.
Certainly not without risks. While it provides stability and convenience, it also has significant vulnerabilities. The very interconnections that make U.S. debt a linchpin can also transmit and amplify stress across the globe. There's a long-running debate about the systemic risks of a world so reliant on one country's debt and currency. There's the modern analog of the Triffin dilemma, right? The world's demand for risk-free dollar assets keeps rising for reserves and collateral, which encourages the U.S. to issue more debt to satisfy that demand. But if that debt grows much faster than the U.S. economy or its tax base, investors could eventually doubt the Treasury's ability to honor obligations without resorting to inflation or, worse, default. The safe asset status is ultimately backed by perceptions of U.S. fiscal health. If that comes into serious question, the whole structure could crack.
And with U.S. debt now consistently over 100% of GDP, this is a real concern, not just theoretical.
It adds to the vulnerability, especially when combined with political uncertainties like those recurring debt ceiling standoffs. A Peterson Institute analysis warned that the safe asset status hinges on perceptions of U.S. fiscal capacity, and any threat to Treasury's credibility poses an increasing threat to the global financial architecture. There's also the issue of dollar strength impacting other countries. The dollar's reserve status means there's persistent global demand for it, keeping its exchange rate higher than it might be otherwise. This makes U.S. exports more expensive and constrain emerging markets because many borrow in dollars. When the dollar strengthens, often during crises when investors flee to the safety of treasuries, those dollar-denominated debts become harder for them to service, a real problem for them.
So the world pays a price for dollar dominance, in a way.
Yes, the U.S. gets cheaper financing, but others may face more volatile capital flows and exchange rates. It's a structural asymmetry. And even the market for treasuries itself has shown fragility at times. Episodes like the September 2019 repo rate spike and that March 2020 dash for cash show moments where the treasury market itself struggled with liquidity, raising questions about its capacity to absorb shocks without disruption. If institutions ever doubt they can quickly convert treasuries to cash when they need to, the entire collateral chain could seize up. The safe asset itself could become a source of instability.
And finally, geopolitics. Foreign holders like China holding trillions in U.S. debt. That has to be a factor.
That's a significant geopolitical risk. Countries with large holdings theoretically have financial influence, that sort of nuclear option of dumping treasuries. Now, this would likely hurt the seller as much as the U.S., creating a mutual vulnerability that probably restrains such actions. But it's a precarious balance. Geopolitical disputes raise the question of whether this financial interdependence will remain a deterrent or become a battlefield. Sanctioning countries out of the dollar system could, over time, encourage blocs of nations to try and insulate themselves from U.S. debt reliance, maybe through local currency trade or buying more gold. While these efforts are marginal right now compared to the dollar's dominance, the dollar's share of reserves actually ticked up recently. The political risk of over-reliance is a topic of active global discussion.
And the concept of exorbitant privilege versus exorbitant duty. The U.S. gets a benefit, but also has a responsibility.
Yes, the world's dependence means the U.S. must supply safe assets and liquidity during global panics. The Fed often has to act as a global lender of last resort because dollars and treasuries are the only real remedy for a global dollar liquidity crunch. If the U.S. ever mishandled this responsibility, perhaps domestic politics prevented sound debt management during a crisis, it could cause severe global contraction. It places a significant burden on U.S. institutions to act, at least sometimes, in the interest of global stability.
It's a latent risk, then. The stability of the entire network hinges on continued sound U.S. monetary and fiscal policy management.
Precisely. The tightly woven global financial tapestry centered on U.S. debt is incredibly strong in many ways, but its very interconnectedness is also its greatest vulnerability.
Okay, let's do a bigger recap here before we move into the default scenario itself. We've seen how U.S. government debt, particularly Treasury securities, became the undisputed anchor of the global financial system. From being the key reserve asset under Bretton Woods, solidified by the petrodollar system, to serving as the essential collateral in global banking and fueling international trade through the dollar payment network, U.S. Treasuries are intertwined in nearly every major financial function worldwide. This has created powerful network effects and a self-reinforcing cycle that makes the system incredibly robust, but also uniquely vulnerable should that core anchor falter. Let's reinforce some key facts before we move on. What's the rough percentage of global foreign exchange reserves held in U.S. dollars?
Just under 60%. So the U.S. dollar is the dominant reserve currency, holding just under 60% of global foreign exchange reserves.
And how much in U.S. Treasuries do foreign investors collectively hold, roughly?
As of early 2025, about $8.8 trillion. Foreign investors collectively held about $8.8 trillion in U.S. Treasuries as of early 2025.
In the U.S. repo market, roughly how much of the collateral is U.S. Treasuries?
Roughly two-thirds. U.S. Treasuries make up roughly two-thirds of all collateral posted in the U.S. repo market.
What percentage of global trade finance is denominated in U.S. dollars?
Around 80%. Around 80% of global trade finance is denominated in U.S. dollars.
In the SWIFT payment network data again, what was the dollar share?
Nearly half of global payment messages involve the U.S. dollar, specifically 49.1% in August 2024, and that rises to 60% when excluding payments within the Eurozone. Nearly half, specifically 49.1% in August 2024, of global SWIFT payment messages involve the U.S. dollar, rising to 60% when excluding intra-Eurozone payments.
And finally, just how big is the U.S. Treasury market compared to others?
It is, by far, the world's deepest and most liquid government bond market. No contest, really. The U.S. Treasury market is the world's deepest and most liquid government bond market.
So we've established just how central U.S. debt is. Now, let's confront the unthinkable. What does it actually mean for the U.S. government to default?
Well, generally, a sovereign default is when a national government fails to meet its debt obligations. That could be a missed interest or principal payment, or maybe a unilateral restructuring that harms creditors. Basically, it means they are unwilling or unable to pay.
And you mentioned a technical default being different for the U.S. How so?
Yes. A technical default for the U.S. is typically defined as failing to meet obligations on time for reasons other than actual insolvency. It implies the U.S. government can pay in the long run, it has the capacity, but something is preventing them from doing so right now.
And the most likely trigger for that isn't economic collapse, but political gridlock.
Precisely. The most likely trigger is a failure by Congress to raise the federal debt ceiling in time due to political deadlock. The debt ceiling is a legal cap on how much the U.S. Treasury can borrow.
So if Congress doesn't raise or suspend that limit, the Treasury simply runs out of cash to pay all its bills as they come due.
It runs out of cash and exhausts the extraordinary measures it uses to juggle funds. At that point, it physically can't pay all the bills coming due simultaneously. This nearly happened in 2011, and again just recently in 2023. Partisan standoffs brought the U.S. literally within days of default.
I remember those tense moments. 11th hour deals were struck just barely.
Yes, but those near misses really demonstrated how political deadlock can indeed jeopardize the ability to honor obligations, and even just the threat has consequences. The 2011 brinkmanship led to the most volatile week for U.S. stocks since the 2008 crisis and resulted in the first ever S&P downgrade of U.S. credit from AAA.
And rating agencies like Fitch cited repeated debt ceiling fights for their recent downgrades too, right?
Fitch explicitly cited the deterioration in governance standards due to these standoffs when it downgraded the U.S. to LAA+ in 2023. While other triggers are theoretically possible, like a brief accidental technical default in 1979 due to a processing glitch, the debt ceiling impasse is really the primary way a U.S. default scenario would likely be set in motion today.
Okay, so if that political failure did happen, if they didn't raise the ceiling, what are the immediate consequences for the U.S. bond markets? Chaos.
Absolute chaos. Financial markets would be thrown into turmoil. A default, even a technical or short-lived one, would severely shock bond markets and fundamentally undermine confidence in treasuries. Investors would immediately demand much higher yields, higher interest rates, to compensate for the suddenly apparent risk, causing existing bond prices to plunge.
Like that 1979 accidental default you mentioned, where T-bill yields jumped significantly and stayed higher afterwards.
That's a key example. It shows the potential lasting effects even a brief missed payment can have on borrowing costs. In a full-blown debt ceiling default, major credit rating agencies would act swiftly. S&P stripped the U.S. of its AAA rating after the 2011 year scare, and Fitch downgraded in 2023, citing the debt ceiling fights. A formal default would almost certainly trigger immediate widespread downgrades across the board from all major agencies.
And what about market liquidity? Treasuries are supposed to be the most liquid asset on Earth. Does that just stop?
A default would severely impair the ability to trade in and out of Treasury bonds. Liquidity would dry up fast. It would trigger massive volatility across government debt, stocks, and other securities because Treasuries are the bedrock, the foundation. If U.S. Treasury payments are actually missed, banks and investors might refuse to accept those specific defaulted bonds as collateral for securing trades and loans.
Which could freeze those short-term funding markets we talked about earlier, like the repo market. The plumbing clogs up.
Precisely. The financial plumbing would seize up, and dysfunction would quickly spread into derivatives, mortgage, and commodity markets. Everything is connected. The fundamental trust that U.S. bonds will be paid on time, which is a cornerstone of global finance, would be broken, shattered. This would lead to a spike in interest rates across the board and a widespread sell-off of even unrelated assets as investors worldwide scramble for safety, though finding actual safety would be incredibly difficult in this scenario.
The confidence shock must be immense, hard to overstate.
It would be profound and severe. The long-held assumption, the bedrock belief, that the U.S. always pays its debts would be shattered. Even a short breach is expected to cause a major drop in confidence. Analysis warned this could prompt a surge in rates and a plunge in equity prices. During the 2023 standoff, we actually saw investors demanding unusually high yields on very short-term debt maturing right around the projected default date, just reflecting the fear of non-payment. Markets are pricing it in.
And the U.S. government would almost certainly have to pay higher rates on future debt to convince buyers to lend again, making deficits worse later.
Yes, in the longer run, they would likely face significantly higher borrowing costs. The risk premium would stick around.
Quick pause. Unlike most sovereign defaults driven by economic collapse, a U.S. default is uniquely tied to political failure over the debt ceiling. But the immediate effects on financial markets would be severe. Bond yields spiking dramatically, ratings cut across the board, and a potential freezing of short-term funding markets, like the repo market, because the trusted collateral is suddenly questionable.
Okay, so what's the immediate political fallout in the U.S. if this happens back in Washington?
Oh, a media crisis in Washington. An intense blame game would erupt instantly. The president and congressional leaders would point fingers furiously at each other. Previous close calls saw palpable public anger. The 2011 standoff significantly worsened Americans' view of Congress, reflecting deep frustration with the brinkmanship. A real default would likely trigger an even stronger, perhaps furious, public backlash. There would have to be emergency negotiations to fix it, like immediately.
Intense pressure to resolve it quickly. You'd see round-the-clock emergency negotiations on Capitol Hill to raise the debt limit or somehow authorize payments. Both parties would be under immense pressure to find some temporary solution maybe a short-term extension, just to stop the bleeding in the markets and economy. There might also be exploration of extraordinary measures, like invoking the 14th Amendment to bypass Congress, but those would almost certainly face legal challenges and just add more uncertainty when certainty is desperately needed.
The urgency would be extreme, coming from everywhere.
Yes. With warnings pouring in from economists, business leaders, and international allies, stressing the need to restore confidence immediately. And U.S. leadership credibility on the world stage would take a severe hit. The U.S. has never deliberately defaulted on its debt. Failing to prevent this would reflect a serious breakdown in governance. Officials seen as responsible would likely suffer lasting political harm. The 2023 showdown already raised concerns about a steady deterioration in standards of governance. The crisis would likely dominate future elections. Public trust in government competence would erode, potentially reaching new lows. Americans expect the government to pay its bills. Default feels like a fundamental betrayal.
In the aftermath, would there be calls for change to prevent it happening again?
Almost certainly renewed debates about fiscal procedures. Lawmakers might seriously consider reforms to prevent future standoffs, like proposals to eliminate the debt ceiling altogether, which always gain traction after close calls. Congressional hearings would investigate how it happened. The Fed and Treasury would be deeply involved in managing the fallout and reviewing contingency plans, like how the Fed would treat defaulted treasuries in its operations. A technical default would be a huge wake-up call, potentially prompting the U.S. political system to finally rethink the wisdom, or lack thereof, of using national creditworthiness as a political bargaining chip.
Beyond the markets and politics, what are the short-term economic effects in the U.S.? How does it hit Main Street?
The shock ripples quickly into the real economy because financial markets and the real economy are so tightly linked.
Stock market turmoil, obviously. That hits retirement accounts.
A sharp sell-off is very likely, as investors panic and move to whatever safety they can find, if any. The 2011 near miss caused the most volatile week since 2008. A true default would likely see even more extreme volatility. Household retirement accounts, 401ks, investments would lose value, damaging consumer confidence as people see their savings shrink overnight.
And disruptions to federal spending, actual checks not going out.
Yes. If Treasury can't borrow and runs out of cash, it simply has to stop paying some bills. While prioritizing interest payments might happen initially to try and maintain the bond market's function, that means slashing other spending immediately. Federal expenditures could be delayed or halted. This includes paychecks for federal employees and the military, Social Security benefits, and Medicare reimbursements to doctors and hospitals.
So millions of Americans could see delayed payments for essential things. Social Security, military benefits.
Potentially, yes. Treasury warned it might not be able to pick and choose payments in previous close calls, possibly just having to wait until there's enough cash in the account to pay all of a given day's obligations. The 2023 scare raised specific concerns about Social Security checks and payments to federal contractors being halted or delayed. Real impact on real people.
A freeze in government spending like that sounds like a fast way to tank the economy. A huge chunk of demand vanishes.
It is. Goldman Sachs economists estimated that hitting the debt ceiling could immediately halt about 1/10 of U.S. economic activity. Just stop it cold.
1/10. That's a massive shock. Unprecedented, really.
And confidence would plummet across the board. Consumers and businesses would lose confidence rapidly. Consumer spending could pull back sharply as people feared job loss or delayed government payments. Businesses might postpone investment or hiring due to the sheer uncertainty and higher borrowing costs resulting from the market chaos. Credit markets would tighten as banks become more risk-averse, making loans harder and more expensive for households and companies.
All pointing towards a recession. Maybe a deep one.
Experts suggest a default would almost certainly tip the U.S. into recession. Unemployment could rise significantly, and ironically, defaulting might actually increase the long-term debt burden because the higher interest rates demanded by investors after a default could divert hundreds of billions in future taxpayer money just to paying interest.
A vicious cycle of economic pain, leaving potentially lasting scars on the economy.
Yes, even if the default itself is technically short-lived, the damage could linger.
And this wouldn't just be a U.S. problem, we keep saying that. What about the international consequences? How does this ripple outwards?
A U.S. default is fundamentally an international event, not just domestic. As we've established, treasuries are held worldwide, and the USD is the primary reserve currency. It would send profound shockwaves through global finance.
Global market volatility then. Stocks, bonds everywhere.
Havoc. Steep stock declines worldwide. Turmoil in international bond markets. U.S. debt is the benchmark safe asset. A loss of confidence would trigger a flight to other perceived havens. But where do you go if the most safe asset is suddenly risky? This likely leads to general risk aversion and asset sell-offs everywhere, a cascade of selling from Europe to Asia, an immense strain on foreign institutions holding U.S. assets. Global credit conditions could tighten dramatically as lenders become extremely cautious.
What about foreign holders of treasuries, like central banks in China and Japan? What happens to them?
Countries like China and Japan hold trillions in treasuries as reserves. Default would make them fundamentally question the reliability of U.S. bonds. They might respond by reducing holdings over time, maybe diversifying away, or demanding higher rates to compensate for the new risk, raising America's borrowing costs in the long run.
And in the immediate term, their existing reserves lose value, just like that.
Yields spike, bond prices fall. Their foreign central bank reserves would suddenly be worth significantly less on paper. This particularly hurts countries with large dollar reserves and could contribute to financial crises in emerging markets whose stability often depends heavily on the value and liquidity of those reserves. Foreign officials have warned in the past that a U.S. default is like playing with fire for the global economy. They see the danger.
And the dollar's reserve status itself would be threatened, wouldn't it? The core pillar.
That status rests partly, maybe largely, on the absolute trust that the U.S. government pays its debts. Default undermines that trust severely and could weaken the dollar's value over time. In the long term, rivals would see an opportunity. China wants to internationalize the renminbi. A U.S. stumble could bolster Beijing's case, even if the renminbi is only, about 3% of global reserves now. It gives them an opening.
Any dent in the dollar's reputation is significant given its dominance?
It is. Over half the world's reserves are in USD. Erosion of confidence could gradually diminish a core pillar of American economic influence and power. A self-inflicted default is, in a way, an own goal that benefits rivals.
And diplomatic strain. Allies would be furious.
Strain on relations with allies, they rely on U.S. financial stability. Foreign leaders urged swift resolution in past standoffs. U.S. reputational damage regarding global leadership and reliability would be immense. The IMF would warn of heightened risks to the global economy. Worst case, if the default persisted for any length of time, it could trigger a worldwide recession. U.S. ability to respond to international crises or fulfill obligations like foreign aid or military commitments could be hampered if its own finances are in chaos. The effects would be felt far beyond American shores, potentially reshaping global economic dynamics if confidence isn't quickly and fully restored.
Okay, another major recap. We've just explored the potential chaos of a U.S. technical default. 2. Triggered not by economic collapse but by political gridlock over the debt ceiling, it would instantly plunge U.S. bond markets into turmoil, leading to credit downgrades and freezing vital funding channels like the repo market. Domestically, it risks disrupting government payments, triggering a stock market crash, and likely pushing the U.S. into recession. Globally, the impact would be unprecedented, diminishing the value of foreign central bank reserves, threatening the dollar's status, and potentially causing a cascade of selling and tightening credit conditions worldwide. This isn't just a U.S. problem. It's a global risk stemming from the very core of the international financial system. Let's review some key facts about this potential scenario. What is the most likely trigger for a U.S. technical default?
Political gridlock in Congress failing to raise the debt ceiling. A U.S. technical default is most likely triggered by Congress failing to raise debt ceiling due to political gridlock.
What was the major consequence of the near miss in 2011 regarding U.S. credit rating?
S&P downgraded U.S. credit from AAA, a historic first. Even a near miss in 2011 led to S&P downgrading U.S. credit, a historic first.
Which rating agencies have explicitly cited debt ceiling standoffs in their downgrades?
S&P and Fitch have both done that. Credit rating agencies like S&P and Fitch have cited debt ceiling standoffs in their downgrades of U.S. debt.
What kind of payments could a U.S. default disrupt domestically? Things people rely on.
Things like Social Security checks and military salaries, federal employee paychecks. A U.S. default could disrupt payments like Social Security checks and military salaries.
What was the estimate from Goldman Sachs on how much of U.S. economic activity could halt if the debt ceiling is hit?
About 1/10, a huge hit. Well, Goldman Sachs estimated hitting the debt ceiling could immediately halt about 1/10 of U.S. economic activity.
What do experts suggest is the likely outcome for the U.S. economy in a default scenario? Recession.
Yes, it would almost certainly tip the country into recession. Experts suggest a U.S. default would almost certainly tip the country into recession.
Who globally is directly exposed to value loss on their assets if U.S. Treasuries fall in value during a default?
Foreign governments and investors holding trillions in treasuries as reserves are directly exposed. Foreign governments and investors hold trillions in U.S. treasuries as reserves, directly exposed to value loss in a default.
What is a major international consequence for the US dollar's global position?
It would undermine confidence in its role as the world's primary reserve currency, a major blow. A U.S. default would undermine confidence in the U.S. dollar's role as the world's primary reserve currency.
Okay, so to truly grasp the potential scale of a US default, it helps to look back at other sovereign defaults throughout history. Why is it crucial to study these past events? What can we learn?
Well, it's for understanding global financial stability, international capital markets, and that constant interplay between national policies and powerful international forces. Governments borrow from all sorts of sources: domestic markets, international markets, other governments, the IMF, the World Bank. Because it's a multi-trillion-dollar global debt network, one default, especially a significant one, can have really far-reaching consequences. Studying history offers lessons for both debtor and creditor nations, helping improve crisis prevention and management, and maybe enhancing the resilience of the international financial architecture itself. Historical analysis shows defaults often cluster, kind of correlating to boom-bust capital flow cycles, which points to their systemic importance. They don't usually happen in isolation.
And defaults aren't just a modern thing, they go way back.
Not at all. The first recorded instance is supposedly ancient Greece in the 4th century BC. European states defaulted back in the 16th century. There have been hundreds since the 19th century alone across various regions and times, and they do tend to bunch up, often following boom-bust cycles in capital flows. These cycles usually start with lending booms, lots of optimism, and then busts triggered by factors like deteriorating trade terms, recessions in core countries, or rising international borrowing costs due to monetary tightening in creditor nations, like the Fed raising rates.
So systemic factors, global factors, really shape the environment for defaults. It's not always just the country's fault.
Shifts in global investor risk appetite, often driven by major economy, monetary policy, or large external shocks, can lead to periods of exuberant lending, risk on, followed by sudden stops or reversals of capital, risk off, that can push multiple vulnerable nations into crisis simultaneously. The pro-cyclical nature of capital flows rushing in during good times, rushing out during bad, amplifies these booms and busts. It's an inherent instability.
And what are the common causes of these defaults? Is there a pattern?
It's rarely a single cause. It's usually a complex interplay of internal vulnerabilities within the country and those external shocks. Internal vulnerabilities include things like persistent fiscal deficits, spending too much, not taxing enough, unsustainable debt accumulation, especially debt in foreign currency or with short maturities, weak economic structures like over-reliance on a single commodity export, flawed macroeconomic policies such as overvalued currency pegs or inadequate financial supervision that allows bubbles, and political instability or governance issues like corruption.
And external shocks act as the catalysts, the triggers that expose the weakness.
Yes, often they are. Examples include global recessions like the GFC triggering Greece, sudden stops in capital flows, sharp increases in international interest rates like the 1980s, collapses in commodity prices, Russia in 1998, and contagion, where crises spread like a virus as investors reassess risk everywhere. Globalization has amplified contagion by increasing the speed and scale of capital movements. But the interaction is crucial. A strong nation might weather a shock, but a fragile one is pushed into crisis by the exact same shock.
Okay, let's pause there. Studying past sovereign defaults shows they are a historical pattern, often clustering during global financial cycles. They stem from a complex mix of a country's own vulnerabilities like fiscal deficits, high debt, or weak policies exposed and triggered by external shocks such as global recessions, sudden stops in capital, or rising international interest rates. Let's look at Greece specifically. The crisis erupted late 2009, but had deep roots, right? It wasn't just the GFC.
Yes, definitely deep roots. Decades of what can only be called fiscal profligacy, excessive public spending, generous welfare state, inefficient tax collection, leading to persistent high deficits and burgeoning public debt. By 2000, its debt to GDP was already over 100%, and the deficit was well above the EU limits, even before they fully adopted the euro. Some analysis suggests finances were unsustainable as early as the mid-1970s. Things blew up in October 2009 when the new government revealed that previous administrations had systematically underreported budget deficit and debt data for years. The 2009 deficit was revised dramatically upwards, shattering market confidence and sending Greece's borrowing costs soaring almost overnight.
And being in the Eurozone was a unique challenge for them, a constraint.
Membership initially meant lower borrowing rates, which maybe encouraged some of the borrowing, but crucially, they gave up monetary policy autonomy. They couldn't devalue their currency to regain competitiveness. When the global financial crisis hit, it exposed Greece's underlying weaknesses and unsustainable debt trajectory. It also highlighted a fundamental challenge in the Eurozone structure. A monetary union without a strong fiscal union or robust mechanisms for dealing with asymmetric shocks or fiscal irresponsibility by one member. The no bailout clause in the treaty proved politically difficult to uphold when a crisis in one country threatened the whole bloc's stability. Without an independent exchange rate, adjustment had to be internal, meaning severe austerity, wage cuts, pension cuts, which was politically divisive and socially incredibly painful. I called it internal devaluation.
Contagion fears were rampant across the Eurozone then, the PIEs.
Yes, fear spread quickly to other vulnerable members, Portugal, Ireland, Italy, Spain. Bond yield spreads between these countries and Germany widened dramatically. The euro area crisis lasted years, with several members unable to repay their debts or bail out their banks without external aid. This forced unprecedented rescue operations from the EU and IMF, altering the Eurozone framework, leading to new support mechanisms like the temporary EFSF and the permanent ESM, European Stability Mechanism. The European Central Bank, ECB, also played a critical, maybe controversial role in stabilizing markets through bond purchases like the S&P and OMT programs and other interventions.
The scale and domestic impact in Greece were exceptionally severe, weren't they?
Deep and lasting damage. Peak debt to GDP reached around 180%. From 2009 to 2017, nominal debt actually rose slightly, but the debt to GDP ratio surged primarily because GDP itself contracted so sharply. The economy shrank by about 25% from its pre-crisis level. Real GDP just plummeted, and the social consequences were devastating. Unemployment hit nearly 25% overall, youth unemployment soared to around 50%. Widespread impoverishment, loss of income, loss of property, a severe humanitarian crisis emerged. And the austerity measures demanded by the lenders, cuts to spending, pensions, big tax hikes, compounded the hardship for ordinary Greeks.
The international response was led by the Troika. Who was that again?
Yes, the Troika consisted of the European Commission, EC, the ECB, and the International Monetary Fund, IMF. They orchestrated these unprecedented rescue packages. The first bailout in 2010 was $110 billion. The second in 2012 was $130 billion, which included a 53.5% haircut for private sector bondholders, the largest sovereign debt restructuring in history at the time. A third bailout program was agreed in 2015 after more political drama. But these bailouts were contingent on Greece implementing incredibly stringent austerity measures and structural reforms. The nature of this intervention and the severity of the austerity sparked intense debate about program ownership, national sovereignty, and socio-political sustainability. The deep economic contraction, arguably exacerbated by front-loaded austerity in an economy that couldn't devalue its currency, led to serious questions about the design of adjustment programs within a currency union. Did the medicine make the patient sicker initially?
Okay, another brief pause. The Greek crisis was a painful example of fiscal irresponsibility meeting the constraints of a monetary union without fiscal flexibility. Decades of overspending caught up, leading to severe recession and social crisis. While massive bailouts were organized, the imposed austerity sparked intense debate and underscored the unique challenges of adjustment without currency devaluation. Let's shift to Argentina now. History calls it a serial default, which sounds pretty bad.
It certainly does.
Argentina has one of the most extensive and, frankly, depressing histories of sovereign default. Records go way back to the 19th century. There have been 9 defaults just in the modern era, with 3 happening in the past 2 decades alone. Notably 1982, 1989, the big one in 2001-02, then 2014, and most recently 2020. This persistent instability points to deep structural and economic vulnerabilities, ongoing challenges in maintaining fiscal discipline, and recurrent political difficulty in building consensus around sustainable policies. The 2001 default was massive for its time, the biggest ever then.
It was the largest sovereign default at the time, yes. In December 2001, Argentina ceased payments on roughly $93 billion to $100 billion of its external debt. A huge amount back then. The causes were multifaceted, as usual. It followed a painful 4-year recession. Key causes included large, persistent fiscal deficits and a severely overvalued currency. That was due to a rigid 1-to-1 convertibility plan pegged to the US dollar established back in 1991. This peg constrained monetary policy and seriously eroded export competitiveness over time. Conditions deteriorated rapidly, leading to a run on the banking system and massive capital flight. The government then imposed the infamous Corralito restrictions on bank deposit withdrawals, which crippled economic activity and fueled widespread social unrest.
The socioeconomic impact sounds catastrophic, maybe even worse than Greece in some ways.
Catastrophic. The convertibility plan was abandoned, the peso was devalued and allowed to float, and it rapidly depreciated from 1.1 parity to nearly 4.1 against the USD. The currency collapse and default led to chaos. Real GDP fell 11% in 2002 alone, and GDP per capita contracted about 20% over the crisis period. Inflation surged over 40%, and the social cost was immense. Unemployment hit 25%, poverty rate soared to over 55%. Widespread social protests, looting, and extreme political instability, Argentina cycled through 5 presidents in just 2 weeks in late 2001, early 2002. Despite the chaos, some local communities showed remarkable resilience, organizing alternative barter systems and worker-run cooperatives to survive.
Were the international repercussions massive? Did it trigger global panic like later crises?
They were significant, but didn't trigger the immediate global financial panic we saw with the Asian or Russian crises. The primary impact was chilling investor sentiment towards emerging markets more broadly, raising borrowing costs for other countries perceived as risky. But there was that unique and very long protracted legal battle afterwards.
Ah, the holdout creditors. The vulture funds.
Yes, sometimes called vulture funds, though the creditors themselves dislike that term. These were bondholders who rejected Argentina's restructuring offers in 2005 and 2010 and decided to litigate in U.S. courts demanding full repayment. Argentina offered restructurings with significant haircuts, which most creditors, about 93%, eventually accepted. But the remaining 7% holdouts continued litigating. They cleverly used pari passu, equal footing clauses, in the old bonds to argue Argentina couldn't pay the restructured bondholders unless it also paid the holdouts in full, including all accrued interest. U.S. courts eventually sided with these holdouts. This legal saga severely complicated Argentina's ability to regain access to international capital markets for years and even led directly to another technical default in 2014.
Wow. So this holdout saga actually impacted global sovereign debt architecture? It forced changes?
Profoundly and lastingly. The success of holdouts in U.S. courts raised serious concerns about the viability of future sovereign debt restructurings. If a small minority could block an agreement supported by the vast majority and potentially get a better deal through litigation, it seriously reduced the incentive for other creditors to participate consensually in future workouts. Why take a haircut if you can hold out for full payment? It acted as a powerful catalyst for the widespread adoption and strengthening of collective action clauses, SILEX, in new sovereign bonds issued globally. Enhanced SILEX allow a specified supermajority of bondholders, often 75%, to agree to a restructuring that becomes legally binding on all holders, including any potential dissenters. This helps prevent holdouts from derailing the process. So the Argentine experience, despite being incredibly painful for Argentina, inadvertently spurred important innovation for more orderly sovereign debt workouts globally.
But Argentina kept facing crises, even after that restructuring and the Aga-stage changes. The defaults continued.
Yes. The 2014 technical default was a direct consequence of those U.S. court rulings favoring the holdouts from the 2001 default, blocking payments to the restructured holders. This led to accelerating inflation and rising unemployment domestically. And then in May 2020, Argentina defaulted again, missing a $500 million payment on dollar bonds, its 9th sovereign default. This triggered another round of restructuring negotiations for about $66 billion in foreign law bonds, all against the backdrop of severe economic pressures exacerbated by the COVID-19 pandemic, which hit global credit quality hard, especially in emerging markets. Argentina was one of 5 Latin American defaults that year alone. They did reach a restructuring agreement in August 2020.
The concept of debt intolerance seems really relevant here for Argentina's story. What does that mean?
It is. It's a concept suggesting some countries struggle with levels of debt that might be perfectly sustainable for other countries with similar economic indicators. This is often attributed to factors like weak institutions, persistent political instability, or a history of defaults that damages credibility and trust among investors. For countries suffering from debt intolerance, like Argentina seems to, merely reducing the nominal amount of debt through restructuring often isn't enough. They need to address the deeper root causes, improving fiscal governance, building political consensus for difficult reforms, diversifying the economy away from commodity dependence, and creating a stable environment for long-term investment. An IMF assessment in 2024 again highlighted these persistent challenges for Argentina, requiring not just policy adjustments, but also building broader societal and political support for them. It's a recurring cycle.
Okay, let's recap again. Argentina's history is a cautionary tale of recurrent defaults rooted in persistent fiscal and policy issues, often amplified by external shocks. The 2001 crisis led to massive social upheaval and a unique legal saga with holdout creditors that spurred global changes in sovereign debt architecture. See gas. Despite relief, Argentina continues to face the challenge of debt intolerance, What about other significant defaults and their global impact? The 1980s Latin American debt crisis is often mentioned as a major event.
Often called the lost decade for Latin America. It really ignited in August 1982 when Mexico announced it couldn't service about $80 billion in foreign debt it owed, mostly to commercial banks. Eventually, 16 other Latin American countries and 11 other developing countries had to reschedule their debts. It was a massive regional crisis. The roots traced back to the 1970s oil shocks. Oil exporters had huge surpluses, importers had huge deficits. International commercial banks aggressively recycled those petrodollars, lending heavily, particularly to Latin American governments who were eager for funds for development. Latin borrowing grew dramatically from maybe $29 billion in 1970 to $327 billion by 1982. Even oil producers like Mexico borrowed heavily, assuming high oil prices would last forever. But the situation became completely untenable in the late 70s and early 80s when industrialized countries, led by the U.S. under Paul Volcker at the Fed, tightened monetary policy aggressively to fight high inflation. This caused a surge in global interest rates and triggered a world recession in 1981.
For countries with large variable rate debts,
Yeah.
often short-term, that meant soaring service costs, right? Suddenly unaffordable.
Precisely. Debt service payments for the region just exploded, growing from around $12 billion in 1975 to $66 billion by 1982. The ripple effects were severe. Mexico's announcement triggered a sudden halt in all new lending to the region, a brutal credit crunch. This plunged Latin America into a deep, prolonged recession. Economic growth averaged only 2.3% between 1980-85, leading to a per capita income decline of almost 9% over the period. High unemployment, rampant inflation, falling incomes, rising poverty, hence the lost decade. And it posed a serious systemic threat to international banking. The 9 largest U.S. banks in 1982 held Latin American debt equivalent to 176% of their total capital. Their solvency was genuinely at risk.
Wow, 176% of capital. That's massive exposure. So the international response was coordinated, IMF involved.
Yes. The IMF coordinated efforts with the World Bank and creditor governments. Initially, it involved debt rescheduling, extending payment terms, and providing new loans, but these were conditional on adopting stringent austerity programs and structural reform, like reducing spending, market liberalization, focusing on exports. Later, the U.S.-led Brady Plan in the late 80s, early 90s introduced the concept of voluntary debt reduction. Banks were encouraged to exchange their loan claims for new tradable Brady bonds, often accepting a principal reduction or lower interest rates in return for enhancements like collateralization, sometimes using U.S. Treasuries. This crisis was a real watershed moment. It marked a shift in dominance in sovereign lending from official creditors back to private commercial banks. Resolution became much more complex, involving negotiations with hundreds of banks instead of just the Paris Club of official creditors. The IMF took on a central coordinating role. It underscored the need for new mechanisms to deal with private creditors and paved the way for more market-based solutions like secondary market trading for distressed debt, equity swaps, and eventually the Brady bonds.
What about the 1994 Mexican tequila crisis? That name suggests contagion.
It does, and there was. That crisis erupted in December 1994 when the Mexican government, facing pressure, suddenly announced a devaluation of the peso. It led to a severe crisis with significant international repercussions. Mexico had actually been doing well before that, seen as a model reformer, fueled by joining NAFTA and implementing investment reforms. They used a pegged exchange rate to the USD to attract foreign investment and maintain price stability. But the problem was, this peg, combined with strong domestic demand, led to an increasingly overvalued peso and a very large current account deficit, reaching about 8% of GDP. This deficit was financed largely by volatile short-term capital inflows, hot money, making Mexico highly vulnerable to shifts in investor sentiment, which were exacerbated by political instability and assassinations in 1994 that eroded confidence.
So the devaluation, intended to fix things, actually triggered a panic.
Intended to correct the overvaluation and improve competitiveness, the devaluation on December 20th, 1994, initially about 14%, then forced to float, instead sparked massive investor panic and huge capital outflow. The devaluation was perceived by markets as a sign of weakness and mismanagement, shattering confidence completely. It became a vicious cycle. Capital flight led to further peso depreciation, which caused inflation to spike, crippled Mexican firms with dollar-denominated debt, and pushed the economy into a sharp recession. Many Mexican banks faced insolvency, and the tequila effect spread beyond Mexico's borders. Investors, spooked by Mexico, suddenly reassessed the risks in other emerging markets, particularly in Latin America, but also some in Asia, triggering temporary but significant capital withdrawal and contagion, even in countries with different fundamentals.
Was the international response swift that time?
Very swift and substantial. Learning lessons, perhaps. A $50 billion U.S. IMF-led bailout package was assembled quickly. Mexico implemented stringent austerity, restructured its banking sector, and shifted to a flexible exchange rate regime. It stabilized the situation relatively quickly, and growth eventually resumed. But the cost was significant. Increased public debt and severe hardship for the population during the adjustment. The key lessons were about the risks of relying on volatile short-term inflows to finance large current account deficits, especially under a pegged exchange rate. It showed how quickly sentiment can reverse and contagion can spread in integrated markets. It was a stark reminder of the impossible trinity trade-off in international macroeconomics. Mexico's attempt to maintain a peg with open capital and independent policy proved unsustainable.
Then there was the 1998 Russian financial crisis. Default and devaluation there too.
Yes, in August 1998, the Russian government devalued the ruble, defaulted on its domestic debt, the high-yield GKO Treasury bills, and declared a 90-day moratorium on payments on foreign commercial debt. It sent shockwaves globally. The underlying issues included the difficult post-Soviet transition struggle, persistent large fiscal deficits financed by issuing very high-yield short-term domestic debt, GKOs, and a floating peg exchange rate for the ruble against the USD that had become overvalued. External shocks played a major role. Falling prices for oil and other commodities, Russia's key exports, hit revenues hard, and the negative sentiment from the ongoing Asian financial crisis created risk aversion towards all emerging markets, including Russia. Even a large IMF World Bank rescue package announced in July 1998 failed to restore confidence as capital flight intensified, partly fueled by allegations that some of the loan money was misappropriated or used for capital flight itself. The ruble collapsed, losing about two-thirds of its value very quickly. The GKO default wiped out the savings of many Russians and crippled the banking system, leading to a banking crisis. The economy plunged, real wages plummeted, and social hardship increased dramatically.
And the global ripple effect involved a major U.S. hedge fund, LTCM.
Yes, one of the most notable global effects was the near collapse of long-term capital management, LTCM, a very large, highly leveraged U.S. hedge fund run by Nobel laureates and famous traders. LTCM had huge, complex, and supposedly market-neutral positions across many markets, including significant exposure to Russian debt and related emerging market assets. The extreme market volatility and liquidity crunch following the Russian default caused massive, unexpected losses for LTCM, bringing it to the brink of failure within weeks. Fearing that a forced fire sale of LTCM's enormous positions would trigger a systemic crisis in global financial markets, the Federal Reserve Bank of New York orchestrated a controversial $3.6 billion private bailout by a consortium of major Wall Street banks. The Russian crisis, via LTCM, vividly demonstrated that a default in a seemingly peripheral emerging market could threaten the core of the global financial system through opaque linkages and highly leveraged, unregulated entities. It was a major wake-up call about hidden vulnerabilities and interconnections. It highlighted the systemic risks posed by large, unregulated financial institutions, the opacity of the OTC derivatives market, and how even sophisticated risk models can fail spectacularly under extreme stress. It spurred debates on financial regulation, leverage, transparency, and risk management that foreshadowed the much larger crisis of 2008.
Finally, let's touch on the 1997-1998 Asian financial crisis. That started in Thailand.
Yes, it began in Thailand in July 1997 with the forced devaluation of the Thai baht, and then spread rapidly like wildfire across the region, hitting Indonesia, South Korea, Malaysia, and the Philippines particularly hard. It involved sharp currency devaluations, stock market collapses, widespread corporate bankruptcies, and deep recessions. There were genuine fears at the time of a worldwide meltdown due to the speed and scope of the contagion. The causes were complex. These economies had been lauded as Asian tigers for their high growth rates, masking underlying vulnerabilities. Key issues included unsustainable peg exchange rates to the US dollar that led to overvalued currencies, eroded competitiveness, and large current account deficits. There was also rapid domestic credit growth fueling asset bubbles, particularly in real estate, leading to excessive corporate leverage and doubtful loans in the banking system. A heavy reliance on short-term foreign borrowing, often unhedged and denominated in US dollars, created a dangerous currency mismatch, encouraged by the false sense of security from the currency pegs, and financial supervision was often inadequate to keep pace with rapid financial liberalization.
So the trigger was the attack on the Thai baht.
Speculative attacks on the Thai baht depleted Thailand's foreign exchange reserves, forcing the government to abandon the peg and float the baht on July 10, 1997. This acted as the trigger. It set off a chain reaction. Investors suddenly saw similar vulnerabilities elsewhere in the region: the pegged rates, high short term foreign debt, weak banking systems, and began withdrawing capital rapidly. This led to speculative attacks on other regional currencies, forcing Indonesia, Malaysia, the Philippines, and South Korea to abandon their pegs as well. Indonesia was particularly hard hit. South Korea came very close to defaulting on its massive short term foreign debt obligations. Even Hong Kong faced speculative attacks, one of which triggered a brief global stock market sell off. Japan's own banking problems at the time also played a role, as Japanese banks pulled back lending from the region.
The impact sounds devastating for those economies.
Devastating is the right word. Currencies depreciated sharply, sometimes collapsing. This skyrocketed the local currency value of foreign denominated debt, pushing many highly leveraged firms into distress and insolvency. This in turn crippled banking systems as non performing loans, NPLs, surged. The resulting credit crunch and collapse in confidence led to severe economic contractions across the region. Indonesia's rupiah collapsed, and the country plunged into a deep recession and political turmoil. The international response involved large IMF-led rescue packages, totaling around $118 billion for Thailand, Indonesia, and South Korea. These came with familiar conditions: structural adjustment programs involving tight monetary policy, high interest rates, fiscal tightening, and financial sector reforms. In a crucial move, the U.S. Fed helped facilitate a voluntary rollover of short-term loans from international banks to South Korea in December 1997, which helped avert an imminent default there. Key lessons from the Asian crisis were about the dangers of twin crises, simultaneous currency and banking crises feeding on each other. Devaluations crippled firms and banks with foreign debt, leading to corporate defaults and threatening the banking system. Bank weakness, in turn, hurt confidence and put more pressure on the currency. It highlighted the importance of prudent macroeconomic management, robust financial supervision, and careful sequencing of capital account liberalization. You need strong domestic institutions and regulatory frameworks before fully opening the capital account. And delaying necessary adjustments, like exchange rate flexibility, often makes the eventual crisis more severe.
Okay, one more quick recap. We've surveyed historical sovereign defaults: the 1980s Latin American crisis from petrodollar lending and rising rates, Mexico's tequila effect from an unsustainable peg, Russia's crisis exposing leveraged global finance, LTCM, and Asia's twin crises. Each offers vital lessons on vulnerabilities, contagion, and international responses, setting the stage to understand how a U.S. default compares. So comparing all these past defaults, what are the common vulnerabilities we see recurring, and how do the outcomes differ depending on the country and context?
Well, we definitely see those recurrent vulnerabilities popping up again and again. Unsustainable fiscal policies like Greece, Argentina, 2001, overvalued currency pegs, Mexico, Russia, Asia, Argentina, heavy reliance on volatile short-term capital inflows, Mexico, Asia, and weak financial supervision, Asia. But the outcomes, how bad things got and how recovery happened, often diverge based on key factors. Monetary policy flexibility was crucial. Countries with their own independent currency could devalue, which, while painful initially, could help spur an export recovery, like Argentina post-2002, or boost domestic industry by making imports expensive, like Russia post-1998. Greece, stuck in the Eurozone, lacked this tool and had to rely on that painful internal devaluation through austerity, leading to a deeper and much longer recession. Economic structure and commodity dependence also mattered. Russia's recovery was eventually aided by rising oil and gas prices. Argentina benefited from the global agricultural commodity boom post-2001, but of course that commodity reliance also made them vulnerable to price swings in the first place. And political stability and institutional strength played a big role. The capacity to actually implement difficult but necessary reforms and the credibility of institutions heavily influenced investor confidence and the pace of recovery. Argentina's recurrent crises, for example, point to persistent challenges in building political consensus and strengthening institutional frameworks.
The fear of floating concept seems important too. Why are countries sometimes reluctant to let their currency depreciate, even if it's overvalued?
It is important. Policymakers, especially in countries where the government or corporations have borrowed heavily in foreign currency, like dollars, are often reluctant to let their currency float freely and depreciate. Why? Because devaluation immediately increases the local currency burden of servicing that foreign debt. It can push otherwise solvent companies and even the government towards bankruptcy and trigger financial instability. The Asian crisis was a vivid example of these adverse balance sheet effects. This fear can lead governments to defend unsustainable currency pegs for too long, burning through precious foreign exchange reserves in the process, like Thailand did. Then, when the peg inevitably breaks, the the subsequent devaluation is often much more abrupt, disorderly, and damaging than a gradual adjustment would have been. It's a really difficult policy trade-off. Fixed exchange rates can offer stability and anchor inflation expectations, but they require very strong economic fundamentals, large reserves, or capital controls to be sustainable, especially with open capital accounts. Delaying the necessary adjustment usually just makes the eventual crisis worse.
What factors determined how severe the global ripple effects were from these past defaults? Why did some spread more than others?
It seems to be a confluence of factors. First, the systemic importance of the defaulting country. Defaults in larger countries or regions with significant financial integration into the global system tended to have more pronounced global effects. Greece, being inside the Eurozone, posed a substantial threat because it risked destabilizing a major global currency bloc. Second, the nature and concentration of the creditor base mattered a lot. If the debt was held primarily by systemically important international banks, like in the 1980s LATAM crisis where U.S. bank exposure exceeded their capital, the risk of financial contagion was very high. Similarly, if exposure was concentrated in highly leveraged and interconnected entities like LTCM during the Russia crisis, the failure of those entities could amplify the initial shock dramatically. Third, the contagion channels themselves. These include direct financial linkages. Creditors suffer losses. Trade linkages, the crisis country's demand for imports contracts hurting its trading partners, and, importantly, sentiment or herding effects, sometimes called informational contagion. A default in one country leads investors to suddenly reassess risks in other countries with perceived similar vulnerabilities, triggering capital outflows even if those countries' fundamentals are sound. Think tequila effect, Asian crisis. And finally, the prevailing global conditions matter. A default occurring during a period of global economic strength might be absorbed more easily than one hitting during a global recession or a period of high risk aversion, like the COVID-19 backdrop for Argentina's 2020 default.
So increasing complexity and interconnectedness in global finance mean even defaults in smaller economies can have unforeseen or disproportionate global consequences. It's not just about size.
Yes, that seems to be a key lesson. The Russia 1998 LTCM example is perfect. A default in what was then considered an emerging market triggered a near collapse at a major U.S. hedge fund, which in turn threatened core financial markets in the U.S. and Europe. Risk transmission isn't always direct or obvious. Financial innovation can create new, less transparent channels for contagion to spread. In a way, sovereign defaults act as unexpected stress tests for the global financial system. They often reveal hidden vulnerabilities and interdependencies, sometimes in the core financial centers themselves, highlighting why understanding these complex linkages is so important.
And international crisis management has evolved over time,
Yeah.
learning lessons from each crisis.
Significantly, yes, often shaped directly by the lessons learned from the previous crisis. Early responses, like in the 1980s LATAM crisis, were somewhat ad hoc, mostly IMF-led programs involving emergency financing conditioned on austerity and structural adjustment. The initial focus was mainly on rescheduling debt payments, not necessarily reducing the overall debt burden. The Brady Plan in the late 80s, early 90s marked a shift, recognizing that the debt overhang itself was unsustainable for many countries. It introduced market-based mechanisms for voluntary debt reduction, with banks exchanging old loans for new, tradable Brady bonds, often with principal or interest collateralized by U.S. Treasuries, in return for accepting a reduction in the debt's face value or interest rate. The crises of the 1990s, Mexico 94, Asia 97-98, Russia 98, saw the deployment of very large international rescue packages, again usually led by the IMF, but with significant contributions from major industrial countries. However, the sheer scale and the often harsh conditionality, especially the fiscal austerity and high interest rates imposed during the Asian crisis, drew criticism for potentially exacerbating the economic downturns and creating moral hazard issues. Post-Argentina 2001, the protracted and disruptive holdout creditor battles highlighted major deficiencies in the sovereign debt restructuring framework. This spurred a renewed focus on strengthening collective action clauses, CCECs, in bond contracts. Enhanced CACs, requiring a supermajority of bondholders to agree, became standard practice to make restructurings legally binding on all holders and mitigate the risk of minority holdouts derailing the process. There were also discussions at the IMF about creating a more formal sovereign debt restructuring mechanism, SDRM, essentially a bankruptcy court for countries, but that didn't gain sufficient political consensus, although the ideas influenced subsequent thinking. Then the Eurozone crisis, particularly Greece post-2010, required entirely novel responses within a monetary union. This led to the creation of temporary EFSF and permanent ESM bailout funds, unprecedented intervention by the ECB and bond markets, and moves to strengthen Eurozone governance through initiatives like the banking union and stricter fiscal surveillance. The IMF's role as part of the Troika also remains significant, though controversial. Crisis management continues to evolve.
Okay, so drawing on all this history and analysis, how does the potential for a U.S. default compare to all this? Is it just bigger or fundamentally different?
This is where it gets really, really sobering. First, the scale is just fundamentally different. Argentina's 2001 default was around $100 billion. The 1980s Litum debt crisis involved maybe $327 billion region-wide. Nix's debt peaked around $318 billion. The U.S. Treasury market has over $25 trillion outstanding. The scale is just vastly, orders of magnitude different.
And the systemic centrality. None of those other countries, even systemically important ones like Greece within Europe, were the absolute bedrock of global finance in the way U.S. debt is.
Precisely. Those were regionally or sometimes systemically important defaults, yes, but none served simultaneously as the primary global reserve asset, the benchmark collateral for global finance, and the foundation of international trade settlement for the entire global system in the way U.S. Treasuries do. A U.S. default hits all these roles simultaneously globally, the analogy I might use. Other defaults were like major regional power grid failures, causing localized blackouts and maybe some broader disruption. A U.S. default is like the global grid collapsing at the primary power source. Everything is affected.
And the trigger is different too. That seems critical.
That's a nuance. Most past defaults we discussed were rooted in fundamental economic or fiscal collapse and inability to pay. The U.S. certainly has long-term fiscal challenges with debt over 100% of GDP, but the trigger for a potential U.S. default, the most plausible scenario we're discussing, is unique: a political failure over a self-imposed debt limit. It's a technical inability to pay on time due to political choice, not fundamental insolvency. That's fundamentally different from the economic collapse triggers of most past defaults. Also, think about bailouts. Argentina and Greece got bailouts or restructuring deals facilitated by the IMF or the EU, but who bails out the US? The creditors are global central banks, pension funds, and the entire financial system itself. There's no external adult in the room with enough capacity or authority to orchestrate a rescue of that magnitude.
And the holdout creditor issue that plagued Argentina, could that happen with Treasuries?
That was painful for Argentina, but ultimately spurred positive changes globally with CACs, which are now common in many sovereign bonds, though perhaps less so in older U.S. debt. Would holdouts play out the same way with U.S. Treasuries? It's a different market structure, highly dispersed ownership. But the core risk of making future borrowing much more expensive if trust is broken is fundamentally similar. It damages credibility.
So let's connect the dots. How would the cascading risks we talked about in the U.S. section combine with the global roles from the first section and the contagion lessons from the third section? Paint that picture.
The potential scenarios are unprecedented and deeply alarming. Okay, step by step. A U.S. default triggers immediate Treasury market turmoil, yields spike, prices plunge. Those plunging Treasury prices mean the value of global central bank reserves falls dramatically, weakening their balance sheets overnight. If Treasuries aren't accepted as reliable collateral, the global repo market seizes up, derivatives trading is severely stressed, margin calls escalate everywhere, funding dries up. Global banks holding large amounts of Treasuries face massive mark-to-market losses and stress. Confidence in the ultimate safe asset vanishes. This triggers a flight to safety, but where? If the most safe asset is risky, investors likely move to just general risk aversion, hoarding cash, triggering asset sell-offs everywhere. Stocks, corporate bonds, maybe even other government bonds. This is contagion, but amplified beyond anything seen before because the shock originates at the very core of the system, not the periphery. The dollar itself might weaken significantly due to loss of confidence, or paradoxically strengthen initially in a pure panic flight to liquidity, adding massive uncertainty and straining countries with dollar debt either way. Trade finance, heavily reliant on dollars and dollar-based collateral, could be massively disrupted. And if the political failure in Washington prevents a quick resolution, it would be perceived globally as a fundamental breakdown in U.S. governance, causing a deep and potentially lasting hit to confidence in the U.S. and the entire system built around it.
Let's put ourselves in the shoes of someone dealing with this in real time, just to make it concrete. What would you do if you were the finance minister in Japan right now, holding over $1 trillion in treasuries, and the U.S. defaulted?
You'd be facing potentially catastrophic losses on your country's national reserves, questioning the fundamental safety of your core assets that underpin your financial stability. You'd be scrambling to find alternative safe investments or collateral sources in a market where everything else is also likely in turmoil. There might be no truly safe harbor. You'd be under immense pressure domestically and internationally.
Okay. What would you do if you were a central banker in Brazil, knowing your country and companies have significant dollar debt liabilities?
You'd be watching the value of your dollar reserves plummet while the cost of servicing your country's dollar debt potentially skyrockets as the dollar either strengthens in a panic or weakens due to lost faith, adding layers of unpredictable volatility. You'd be desperate for dollar liquidity for your banks and companies in a global system where dollar funding markets are seizing up precisely because the primary collateral, U.S. Treasuries, is suddenly broken. A nightmare scenario.
And what would you do if you were the CEO of a major global bank sitting in New York or London?
You'd be dealing with crashing asset values on your balance sheet, especially your treasury holdings, frozen repo and funding markets making daily operations incredibly difficult, escalating margin calls on derivatives positions, counterparty risk exploding as everyone doubts everyone else's solvency, and a complete breakdown of trust in the sister's anchor. You'd be desperately trying to manage liquidity, contain risk, and reassure stakeholders in utterly unprecedented and chaotic conditions. Survival mode.
It sounds like the self-inflicted nature of a potential U.S. default, tied specifically to that political brinkmanship over the debt ceiling, makes it uniquely dangerous and perhaps even more damaging to trust than a default caused by unavoidable economic collapse.
It does. That's the default by design element that makes it so worrying to observers. It's a political choice to potentially jeopardize the cornerstone of the global financial system. Using the nation's creditworthiness as a bargaining chip has potentially devastating global consequences far beyond domestic politics.
Okay, final big recap. Comparing historical sovereign defaults like Argentina and Greece reveals common threads of fiscal fragility, unsustainable policies, and painful adjustment, often amplified by external shocks and complicated by issues like currency pegs or holdout creditors. We've seen how crises can cascade globally via financial, trade, and sentiment channels, sometimes in unexpected ways like LTCM. But none of these events match the potential systemic impact of a U.S. default. Given the sheer scale of U.S. debt and its unique role as a global reserve asset and financial bedrock, a U.S. default, particularly one triggered by domestic political choice, poses an unprecedented risk of global financial collapse, far exceeding the contained, albeit painful, consequences of past defaults. Let's hit some key takeaways from these historical comparisons one last time. What are some common causes of sovereign defaults we saw?
Unsustainable fiscal policies, overvalued currency pegs, reliance on volatile short-term foreign capital, and weak financial supervision kept coming up. Common default causes include unsustainable fiscal policies, overvalued currency pegs, reliance on short-term foreign capital, and weak financial supervision.
What was a major factor exacerbating Greece's crisis that countries with their own currencies didn't face?
Lacking monetary flexibility, they couldn't devalue their currency because they were in the Eurozone. Greece's crisis was exacerbated by lacking monetary flexibility, cannot devalue within the Eurozone.
What was unique about Argentina's 2001 default, besides its size at the time?
It led to that very long and damaging legal battle with holdout creditors. Argentina's 2001 default was the largest at the time and led to a protracted legal battle with holdout creditors.
And what global change did that holdout saga ultimately spur?
It pushed for the global adoption of stronger collective action clauses, CKs, in sovereign bonds to prevent minorities from blocking restructurings. The Argentine holdout saga spurred the global adoption of stronger collective action clauses, CKs, in sovereign bonds.
What systemic risk did the 1980s Latin American crisis really highlight?
The huge systemic risk posed by commercial banks holding large, concentrated amounts of sovereign debt from a specific region. The 1980s Latin American crisis highlighted the systemic risk of commercial banks holding large amounts of sovereign debt.
What key global linkage did the 1998 Russian default unexpectedly reveal?
It contributed directly to the collapse of the highly leveraged U.S. hedge fund LTCM, revealing hidden, opaque global financial linkages and leverage. The 1998 Russian default contributed to the collapse of the highly leveraged U.S. hedge fund LTCM, revealing hidden global linkages.
And what kind of crises characterized the 1997-98 Asian financial crisis?
Those devastating twin crises, simultaneous currency collapses, and banking system failures feeding off each other. The 1997-98 Asian financial crisis was characterized by twin crises of currency collapses and banking failures.
So we've traced the rise of U.S. debt to its central, deeply interwoven role in the global financial tapestry. It provides stability and efficiency in normal times, but also creates these unique and profound vulnerabilities.
And a U.S. technical default, unlike most historical defaults driven by fundamental economic weakness, is a risk primarily stemming from domestic political decisions over the debt ceiling. A choice, essentially.
But its consequences on U.S. markets, the U.S. economy, global finance, foreign reserves, the dollar status would likely be far more profound and systemic than any sovereign default we've seen before. Incomparable, perhaps.
And as some of our sources noted, the exorbitant privilege the U.S. enjoys from the world's demand for its debt comes with what could be called an exorbitant duty. That's the responsibility to manage its fiscal and monetary policies soundly, especially during crises, because the stability of this entire interconnected global network hinges on that continued sound management and credibility.
So why should you, listening right now, care about the arcane plumbing of global finance or historical defaults in faraway countries?
Because the value of your investments, the stability of your job, even the cost of goods you buy at the store can be affected, potentially dramatically, by disruptions to this fundamental system.
The world has effectively placed a massive bet on the stability and reliability of U.S. Treasuries, and that bet really defines the modern financial era. The fraying of that fabric, even from a seemingly domestic political issue like the debt ceiling, can be felt everywhere.
The experiences from past defaults and our analysis of the U.S. system reveal a fundamental tension, maybe an increasing one, between national sovereignty, a country's right to make its own political choices, and the disciplines imposed by integrated global capital markets.
So, given the extreme interconnectedness we've explored today, and the fact that a U.S. default is uniquely triggered not by economic necessity, but by domestic political brinkmanship over the debt ceiling, literally using the nation's creditworthiness as a bargaining chip.
Yeah.
This raises a really important, maybe unsettling final question for you to think about.
Is the global financial system now inherently hostage to the stability, rationality, and choices made within the U.S. political system? What does it truly mean for global stability when the ultimate safe asset is exposed to that kind of risk?
It wouldn't take much. One missed payment, one frozen auction, one political standoff too far. If the world stops believing treasuries are bulletproof, the cost won't be just higher interest rates. It could be a seized repo market, a fractured reserve system, a global margin call. Oh, how the silent architecture of leveraged finance begins to creak.
Please like and subscribe.